Welcome to Ty's Daily Market Update. I'm Ty Wong reporting from New York, and it's Friday, July 31st. Okay, this is really just a picture. I mean, this is amazing. So this is part of Spain that is actually on the African mainland, just a little bit south of the Strait of Gibraltar. So people just overwhelm the border guards, and apparently 60,000 migrants get in. This is going to be a problem because Prime Minister Meloni of Italy says we are not going to let you, because in Europe there's a Schengen free travel zone. So if you're European citizen from any European country, you can travel to any other country. Well, this is obviously going to be a problem for the other countries. They don't want tens of thousands of more migrants. The Chancellor of Germany, Merkel, did that and caused all sorts of problems that are going to continue for probably decades. And by the way, this will probably help the French far-right National Front, if they don't do something about this. Okay, so Wall Street Journal reports that situational awareness is down 67% on an AI stock rout. Leopold Aschenbrenner was a German wunderkind. I think he's still only 25 years old, or maybe 26, who used to work for Anthropic and then became a hedge fund. He wrote a famous piece called Situational Awareness about AI. In 2024, he either left or was fired from Anthropic, I believe it was, and he started a hedge fund. And he's a great salesman because he's had raised billions of dollars. So apparently, the beginning of he essentially concentrated his bets in AI and AI-related stock. Been very, very successful. But as earlier this month, as the AI stocks and chip stocks and related stocks fell, his hedge fund lost a lot of money. And because he used leverage, as they dropped, the people who lent him money said, hey, listen, you've got to give us some more margin or we're going to cut all your positions. So what happened was he needed to sell the bulk of his stock holdings to raise cash to pay back these loans, and he ended up selling it to Ken Griffin's investment firm from Citadel, apparently as of Thursday morning. And he sold the listed stocks instead of some of the more valuable stuff, like $3.5 billion of a stake in AI giant Anthropic. He was going to do that and then backed out. But even down 67% in July, they had made so much money that the fund is still up 80% on the year. It had been up 270% before this drawdown. He blamed short sellers who target the firm's positions for exacerbating the fund's losses, and he compared the experience to a bank run. Now, he says he has removed all leverage from the portfolio, so he's not going to have margin calls anymore. So apparently it had amassed, depending on who you read, over $20 billion in asset under management. If he's got 4 to 5 times leverage, he might have been playing with $100 billion worth of stuff. Really was pretty amazing because he had no professional investing experience and was able to develop a fund that got several $100 million. So the question is, are there more cockroaches? Are there more people like this? It's hopefully not a replay of Bill Wang and Archegos in 2021, where he was so concentrated in a number of small stocks and it spread his business over to a lot of different investment banks that it caused billions in losses and eventually basically the collapse of Credit Suisse. So let's look a little closer at this because I think it's worthwhile. Oops. So I took a look, did a little research, and situational awareness had leverage on concentrated AI bets. So as the market fell, lenders required more collateral and they had to sell holdings to raise cash. I think these sales likely contributed to some of the heavy chips-related sell-off earlier this week, and it very likely contributed to the panic equity sell-off that we saw during Warsh's press conference on Wednesday. If you recall, the equity market rallied as he started and then really collapsed. And some folks blamed the fact that the 30-year bond dropped very quickly on inflation fears, but I think this was part of it. So as of quarter 1, the fund's SEC filing showed concentrated positions in Bloom Energy, SanDisk, CoreWeave, AMD, CleanSpark, and IREN. I don't even know what IREN is. He also held SK, Broadcom, Intel, and Nebius. So what I have here is the market capitalization of these companies. So if you have a lot in a small company, presumably you could impact the price dramatically. So this is SanDisk, which does memory chips, had an unbelievable rally from about 600 up to, looks like it was 20, I can't even see it from here, 2,400 at the highs. And you can see starting on Friday, look at this drop. It's a huge 4-day sell-off and bounce, huge 4-day sell-off. And then it bounced. This is Thursday. This is today. Essentially, the bounce after the market realized that the selling is probably over now that he sold the entire portfolio to Citadel, probably something of a 2 to 5% discount just so he wouldn't have to hit the market. Citadel has very deep pockets. They can hold it, play with it, whatever. But down 36%. This was a 36% drop in 4 days, potentially related to situational awareness. And that was the biggest one, and they're a fairly big company. But some of these smaller companies, you're looking at, and it's just the same chart. Those 4 days down, a lot of them down 23%. CoreWeave, AMD is a big stock. Bloom Energy and IREN down 27%. So it looks like the sell-off related to situational awareness and people knowing that they were in trouble, selling in front of them in some ways, as they did with Bill and Archegos, exacerbated this move. So that's why we're looking at it at length. Okay, let's move to Amazon. Amazon shares surged after the company reported cloud computing revenue accelerated for a 5th straight quarter, and they basically eased investor concerns they wouldn't produce a return on these huge expenditures. Revenue jumped 37%, beat expectations by $1.5 billion. Web services generates a 5th of the revenue and most of its profit, fastest pace of growth since 2021. Now, they are spending $53 billion this quarter on property and equipment and raised the 2026 capital expenditures to $220 billion from previously $200 billion. Remember when Meta did this and their stock got crushed earlier this week? Even though they're spending most of this money toward AI, and the outlays were, sent the company into, cash flow negative area. The market's really happy about this because they feel that the accelerating pace of web services revenue and strict cost controls in other areas will be fine. Also, the CEO said that investments would moderate over time because they're building data centers from the ground up. These sites will last 30 years, even though the chips inside them, the equipment inside them will have to be replaced every 5 or 6 years to modernize it. They're showing return. And this very hissy market demands return. The market liked what they saw. Now, compare that to Apple. Apple slides the most since 2025 after supply shortages hurt the outlook. Tumbled the most in 16 months because of component shortages. They're going to sell less. They won't make as much money. Revenue will only rise 9 to 11%. Analysts were looking for 12 and really probably like 13 or higher. They've been struggling to secure enough computer processors and counter fast rising memory costs. They also said services growth would decelerate from the September quarter, impact of regulatory changes. They had weaker than expected revenue in China, and services grew a disappointing 12% under analyst expectations. So they did beat on earnings, but a lot of the guidance is a little weak. And in some ways, Tim Cook is retiring in the middle of the quarter, and the new CEO will be reporting the next time in the next quarter. So maybe it's Tim Cook has had a great run. He's getting all the bad news out right now ahead of the new CEO. So you can see Amazon, 15% gallop on revenue growth and strong guidance. Apple, a 10% drop. I mean, the market is the worst mistress ever, except perhaps silver. There's a temptation to say, do I want to rotate if I'm, if I have Amazon, do I want to sell some Amazon and buy some Apple? You may want to sell some Amazon, but I'm not sure. There is a fair amount of bad news out of Apple. You may get a little bit of a better place to buy Apple, but Amazon, taking a little profit here probably wouldn't hurt. Okay, and just to give you an idea, markets love and hate. So this is this year's capital expenditures planned. You can see that this is Microsoft, this is Meta, this is Google and Amazon. Year to date, Amazon's up 19%, Google up 12%. So market really loving those two names. Microsoft down 10%. That's with a rally, and Meta down 15%. They're really worried about, is Zuckerberg going to burn a lot more money for no good reason? So we will see. In terms of the data today, the ECI employment looked pretty good. Wages are up, but not dangerously. Interestingly, Michigan sentiment was pretty decent despite renewed hostilities in July against Iran, and inflation expectations, especially in the 1 year, anchored at 4.2%. I don't think it's going to go much higher, and the 5 year is pretty steady as well. So that'll help Warsh if he doesn't want to raise rates. Okay, a quick look at Brent. Midpoint of this entire move here in July. We'll see what the weekend and next week brings. Gasoline down a little bit, diesel unchanged, and gasoline remains steady. I think we'll remain here until we get some resolution. Now, bonds are still throwing a fit. Bonds down across the curve, just the overall sell-off from the 2 years, 6 or 7 basis points through the 30-year. But equities are up. Equities are like, the bond market. The bond market thinks they're smarter than everybody else. Okay, fine. They're up. Nice way to finish July, as it looks like. The higher yields are pressuring metals. Gold, again, is fighting, not quite down to 4,000, but up to 4,100. Can't really hold it up there. So a little pressure there. And the higher yields are pressuring crypto as well. Okay, so let's take a look at these bonds. And part of it is bonds have sold off because of inflation fears that the Fed needs to raise rates but won't. I disagree with that. I think a lot of people disagree with that. But here's the last bit. Here's the steepening yield curve. This is the 30-year yield minus the 3-month yield. So it moved from basically 1.15, 115 basis points between the 3-month, which is today's rate, and the 30-year to it's steepened by 23 basis points, which is a fairly substantial move in the space of basically 3 days, 2 to 3 days. Now, taking a step back, that was 1 year. This is a 25-year look. So right now, again, 30-year minus 3-month, it's been much steeper. It's been up as much as 4.5%, and we're only talking about 1.4% here, 140 basis points. So potentially for some room to continue to move higher. We have a fair amount of data next week, employment data. That's going to be important. Okay, dollar yen up to 164, and then you get this big drop on Thursday. So apparently the Ministry of Finance through the Bank of Japan intervened to the tune of $53 billion. They sold $53 billion of dollars and bought yen to push the dollar down and strengthen the yen. Largest single one-day push ever. They should probably hit it again if it's weak. The problem right now is you have a sell-off in bonds and the yields are high. But if there's any more weakness in the dollar, they would be well advised to sell it even more because there's still probably a lot of longs on the yield differential. You get it down to 150, you hurt the market, and they'll think again about really trying to drive dollar yen higher. So I don't think central banks do this and governments do this well enough. You really have to hurt the speculators. This will hurt, but if it bounces back up, it's not going to really hurt that much. Use the opportunity if it comes to sell it some more. So NASDAQ 100, big drop on Wednesday, nice big bounce yesterday. Today open higher, but you're closing a little bit lower here, but it is higher lows. So let's see how, not out of danger, but higher lows are a good sign. The S&P 500 finishing nice finish for the week. Might even break even in July. We'll have to see how the number goes. July typically a good month. Apple drags, but otherwise a very good day for tech. In terms of earnings, Exxon and Chevron reported today. Exxon's down 1.6% because they missed earnings and they missed revenue slightly. Part of the revenue miss is due to the fact that they had some of their refineries are offline, so they couldn't take advantage of the higher prices, and they paid down a lot of debt. Like all the oil majors are paying down a lot of debt, so that's a pretty good sign. Chevron did very well. Next week, big week. It's employment week. We get JOLTS data. We get ADP on Wednesday, and of course the payrolls on Friday. I don't think it's going to be a very strong report, but let's see. Have a great weekend.